Okay, so last time we did the efficient frontier, defined it and sort of set up where it comes from, and I said that we would add a risk-free asset. So, and what is a risk-free asset? In real life, well, the closest thing we have that could come to it is, if you think about it, if I have a loan, right? If I lend somebody money, right? What are the risks associated with doing that? Well, obviously, the first and most important risk is that they won't pay me back, right? And so a risk-free security would have to have very, supremely strong assurances that it will get paid back. And the only entity that we would really say can approximately make that claim is U.S. government debt. So the United States has a very long track record of faithfully paying its debt service and not defaulting on its sovereign debt, which actually happens. I mean, there are a lot of countries in the world, but at least for some of them happens with relative frequency. So in the U.S., we haven't. The United States has not defaulted on its debt. And so U.S. government debt would be a good candidate for at least paying us back. But there's actually an additional source of risk for debt, and that's there's reinvestment rate risk and interest rate risk. So if I have a 30-year loan from the U.S. government and they're paying me 4% per year on that 30-year loan, and then interest rates rise to 8%, well, that's going to affect the value of my loan. Now my payments are too small by half, right? I'm getting half what I should be. And so the price is going to drop to make up for it. So any debt that has an appreciable length of time before it gets paid back is going to be subject to this risk that that interest rates change and affect the prices. Okay, so not only does it need to be from an entity that has no repayment risk, that they will pay it back, it also needs to happen on such a short time frame that interest rates can't really change. So these kind of loans exist. There are 30-day or less than 30-day loans to the U.S. government. So if I loan the U.S. federal government money overnight, right, for one day, the chance that the price moves on me or that the government decides not to pay me back is very, very, very small, right? If the government is not going to pay money back, I'll usually know, or at least get warning signs more than 24 hours in advance. And even if interest rates change, if interest rates double, how much interest am I paying on a one-day loan? I mean, there's almost no interest in that anyway. So a big change in interest rates will have very small effect on price because there's so little interest in that loan. So the closest we can come to thinking about a risk-free rate in real life would be very short-term loans to the federal government. And if that's the case, if we're thinking about those kind of loans, we'll have a standard deviation very close to zero. Right? The prices are just not going to move very much. But also the returns are not going to be very good. In fact, the returns to short-term loans to the federal government are almost zero. So we can draw our little mark here down here, and as an investable security. If you buy a T-bill, this is what you're buying, way down here. But right, naturally, we can combine this security, the risk-free security, with any security on the efficient frontier. So again, this is a portfolio of portfolios. We'll get a new color because now we've mixed the risk-free asset in here. But I can do something like this, right? So if I mix, and let's pick this one. Right, that's the lowest risk one. So if I pick this, I can get anywhere on that line, right? The more risk-free asset I have, the lower return I have and the lower standard deviation I have. Now, I've been giving the last video I did like a nice long speech about how when you combine two things, they actually make kind of a swooping picture, right? They swoop to the left because of diversification. So why is that not happening here? Well, because the risk-free asset has no standard deviation, right? There's no variability at all. And so, right, the whole reason diversification works is that the one security is up when the other one is down some of the time. So if one of the securities is never up or down, right, at all, then it doesn't do any good with diversifying. So we do, in fact, just get the straight line. It's as if they have perfect correlation, because effectively they do, because the other one isn't moving. So this is an option, right? I can invest anywhere in here. But in fact, you can actually do a little bit better than this kind of, because, right, if you think about being all the way on the left, if I'm all the way on the left, I'm 100% risk-free asset. If I'm halfway in the middle, I'm 50% risk-free asset. If I'm right on the efficient frontier, I have 0% risk-free asset. But I can actually go out here, right? So if I go even further, right, it's 100% risk-free, 50% risk-free puts me in the middle, 0% risk-free puts me there. So if I keep going, what is that? Well, that would be negative 50% risk-free asset. Now, how do you have negative in a financial security? Well, you actually can do it. So how this would work would be you would go to your broker or the financial institution you're working with, and you borrow someone else's government debt, right? Somebody else has U.S. government debt. You borrow it from them and you sell it. And then you take that money and you buy more of the efficient frontier portfolio with it. So essentially, it's like taking out a loan to buy more risky asset. Right? So if you take out a loan to buy more risky asset, you're going to get more returns and more risk, right? Because if I have a loan, when it goes down more because the loan is going to stay put, and my financial assets now move by 50% more because I have 50% more of them. And so variability will increase. Returns will increase because the risky portfolio will have higher returns than the loan. And so you get this line that continues on. So if I right about where the end of the line is, that's probably negative 100% risk-free asset and then 200% risky asset. Now, obviously, there's some physical limits to that. You can't walk into a broker and say, here, I have $1. I want you to give me $1 billion worth of someone else's debt that I'm going to sell and then turn around and buy stock market stuff with. Right? They will never let you do that. The risk of default is too high. They'll get caught. If the price moves in 2 seconds and moves against you, then now you're bankrupt and they're on the hook. So there are physical and practicalities to pushing this number out too far, but yes, definitely it is possible to at least short some U.S. government debt and use the proceeds to buy some kinds of risky assets. There's some pretty strong limits on that physically, but it is possible to sort of think in this kind of thing. Okay, now this line that I've drawn. The line that I've drawn was based on assumption that I was investing at this point here, right? So I'm investing here and combining them. But why did I pick that one? Well, that one just kind of ran. I mean, it was the low risk one, but it's kind of random. Could I do better, right? Could I take this portfolio and could I make it better? Well, what's better on this chart? Better on this chart is left and up, okay? So the question is, can I move this line left or up? So let's try moving it left. If I move left, okay, is this possible? Yes, right? I'm investing the risk-free asset and the point at the efficient frontier where the line crosses the efficient frontier. So it's a different portfolio, right? You saw this is where we were, and we're investing at where it crosses. This is where we are now, and we're investing where it crosses. So we're buying a different risky portfolio than in the previous case. Even if we're going to invest somewhere on the brown line, we're mixing it with a different thing. Okay, can I do this? Yes, right? There's a portfolio right there that will work. And what about this? Okay, no, right? This is not feasible. There's no risky portfolio that makes this work. So this is too good. You can't get it. So what's the best one? Well, the best one is right here, right? That's the best we can do. It gets the line farthest to the left. And so we invest right here in this portfolio, right there. Oh, right here. Oh, we invest right there, and then right here, and then down here is the risk-free asset that we mix with it. So we mix the brown portfolio with the risk-free asset, and we can get any one of these risk-return combinations on this line. Any one of those are feasible. Okay. And how do we know which one we want? Well, that depends on how much risk we're willing to tolerate. If I'm a low risk kind of person, then I'll be down here, and if I'm a high risk kind of person, I'll be up here. And so, no matter how risk tolerant you are, everybody, the smartest thing to do is to be somewhere on this line, right? This is as far left as you can go, and that's a pretty important concept. Because of this thing here. Now, before I get to that though, let's label this. So we call this line the capital. Oh man, not brown, black. Black letters type K. Capital market line. Right, this is the capital market line, and what it is it is the best achievable risk and return trade-off in the economy, and it also helps you figure out whether a diversified portfolio is a good one. Right, so if I have a random, right, because these are all individual securities, right, and these red ones are all portfolios. So if we find something, like here, I have a portfolio and it's right here. Well, that's going to be pretty close to the capital market line, and we would say that is pretty efficiently priced and worth investing in. But if you have something that's say way over here, then you'd say, well, why would you buy that? Why would I buy something over here when I can buy that instead and get the same return for a lot less risk? Right, you wouldn't. So the capital market line helps you find what the value should be for diversified portfolios. Now, there's another important piece of logic here that's happening. So if I am a risk, if I don't like risk, I buy down here, which means I buy the risk-free asset and this brown portfolio. If I like risk, if I don't mind it as much as other people, I'm way up here, which means I buy more of the brown portfolio here and negative risk-free asset, right? But everybody, no matter who you are, the smartest thing to do is to buy this portfolio, right? That's the smartest thing to do. Everybody keeps investing in this thing, okay? So let's think about this. If everybody's investing in that thing, let's do a little bit. We're just going to do a little math proof here, a little mental math proof here. So I'm going to come up with an asset. And just for fun, let's say it's Pokemon cards, okay? So we got a nice big collection of Pokemon cards, and we think we're going to make a bunch of money on it. So if I invest in my Pokemon cards and I want to get a financial return, so let's imagine that Pokemon cards are not in this dot, right? They're not in there. This is not something that's in there. Okay. So if it's not in the dot, that means that it is not being invested in, right, by anybody. Nobody wants it. Nobody, because it doesn't. If it was in here, they'd buy it, and they're only buying this. Everybody's only buying the brown one. So it's because it's not in the brown, nobody's buying it. But if it's a financial asset that nobody's buying, its value should drop until it's so cheap that it makes sense to buy it again. And this is not necessarily as true for Pokemon cards because they don't pay you a dividend. But like a dividend paying stock, I mean, it'd be crazy, right? At some point the stock is so cheap, it's a penny, and it pays you $1 dividend, and you'd just be silly not to buy it, right? So for any kind of financial asset that pays any sort of income, it's impossible for it not to be in here because nobody would buy it, and that would drive the price so low that someone would buy it, and then it would end up in the dot, right? So strictly speaking, logically, since all investors invest exclusively in this brown dot and the risk-free asset, any asset not in there would be bought by no one and have a super cheap price, which would then be bought by someone and mess it up. Okay, so that just doesn't make sense. It doesn't make sense. So the assumptions must be wrong. The original assumption must be wrong. And our original assumption was that it's not in the brown dot, right? We picked a random thing and assumed it wasn't in the brown dot. Well, what does that mean? That means that if it's impossible for a random thing not to be in the brown dot, that means everything is in the brown dot. That's why, I mean, that's the educational purpose of the Pokemon joke, right? Every investable financial asset has to be in this brown dot. Pokemon cards, collectible coins, stocks, bonds, real estate, international bonds, stock options, right? Weather derivatives, terror derivatives. If it exists, it needs to be in this brown dot. And so we give this dot a name for that reason. This dot is a special name. We call it the market, extra capital market portfolio. Right? This is the market portfolio right here because it has everything. So everyone who invests buys a mixture of the risk-free asset and a diversified portfolio of everything. That is the rational decision to make. Now, in reality, sometimes people don't do that, but that's partly because if you pick 15 or 20 things or something, that gets you pretty close as long as the 15 or 20 things are different enough. And also there's some other concerns like having to deal with the taxes and the reporting requirements and understanding the market. And, so if I'm I would be a small-time investor if I put money in the market. I wouldn't put very much in right now. And so there are some kinds of assets that are hard for me to invest in because I don't really have this, it's hard to buy real estate when you're a small-time investor. You could buy a real estate investment trust, which would kind of work. Same with commodities. It's hard you need kind of a significant cash commitment to invest in commodity derivatives. You could get an ETF that sort of targets the commodities price, but these are all kind of workarounds. So at some point, the added diversification benefit of me being in Chilean sea bass futures is not enough to justify the trouble of finding an effective way to invest in Chilean sea bass futures, right? So for most people, we just kind of do something that we know is not perfectly efficient because we want to just save time and energy and that kind of thing. But there's a lot of big mistakes people make in investing. So even if we're in a diversified portfolio, a lot of investors will be in a diversified portfolio of U.S. equities. Well, now you're leaving out a bunch of stuff, right? There's no bonds at all in your portfolio, and bonds are a very important diversification asset because they move in a very different way than stocks do. And also you're completely ignoring all the international stock markets, right? So you have a whole bunch of stock markets that do not move in perfect concert with the United States stock market that you're ignoring. And so having a diversified portfolio of U.S. equities is really not following the logic of this principle. But if you have international stocks, domestic stocks, bonds, some cash, and it's kind of a nice mix of normal financial assets, you should be not too far from this kind of outcome. Okay, so that is the logic behind indexing. So if you've ever done a 401k plan for work, and you've noticed they have total market index funds, or the Vanguard S&P 500 fund, or whatever, it's things that track a broad index of assets. This is the logic behind why that makes sense, right? It's better to invest in a broadly diversified set of things than try to pick and choose things to invest in, unless you have some kind of mental edge over the market, which we know in aggregate is basically a zero-sum game. If you think oil stocks are hot and you buy them, someone else thinks oil stocks are cold and are not buying them, and one of you is going to be wrong. So there's the way to just broadly lift all boats is to do a diversified strategy, and so that's usually the first thing that you would do if you're investing. But we're actually not. This is not an investments class, right? This is corporate finance. So why do we care about all this? Well, this is important because notice now, this actually is a really important conclusion kind of hidden in here, right? We talked about return and risk, and we said, sort of broadly speaking, we would think that the higher the return, the higher the risk. But it's actually much, much more specific than that. Under these assumptions, right, not only do you get the higher the return, the higher the risk, but it's a line. So it's literally a line, an amount. If I increase return 2%, I will increase standard deviation by 2 times the slope of this line. Right? It's linear, which is much more simple than you'd think. And right, and not only is it linear, it also is a certain kind of risk. Right? It's not just any standard deviation, it's the standard deviation of a diversified portfolio that matters. And these assets don't have the same standard deviation when you put them in a portfolio. Right? When you mix them together in a portfolio, the standard deviation changes. That's why you get the swoop. And so the key thing is there's a linear relation between the return an asset has and the standard deviation of the portfolio created when you mix it with stuff. Okay, the diversified standard deviation. And so actually, when we think about an individual security, we care about its contribution to a diversified standard deviation. Okay, so an asset might have a lot of risk, none of which is contributing to a diversified standard deviation. So I'll give you a great example. If I gave you an offer, say, hey, you pay me $100, and then we'll flip a coin. And if it comes up heads, I'll give you $210, and if it comes up tails, I'll just keep the money. Okay, so most people wouldn't take that. It's kind of a risky bet. You obviously, it's not like Vegas, right? You have an edge, right? You're like the house in this case because on average you make $105, but a lot of people, right, don't necessarily enjoy having $100 disappear from their checking account. And so as a one-time thing, we probably, there's a lot of people who probably wouldn't take it. I'm not sure that I would, honestly. But if we can do this over and over and over again, right, over and over and over and over again, we are guaranteed to make money. Every time we flip, we make 105 on average, and the dispersion of outcomes is going to shrink every time we flip, right? Because it's possible to get heads, and it's still possible to get heads, and it's kind of possible to get heads, but you're not going to get heads, right? The probability of that is very, very, very low. And so given enough flips, you're going to end up with a boatload of money. In fact, it'll be basically infinite money. You just flip coins as fast as you can. So what's happening? Where did the risk go? Well, these individual coin flips, even though they have a high standard deviation, have no contribution to the diversified standard deviation because they're completely uncorrelated with each other, right? If you had to flip one coin one time for all of the coin flips, well, there's no way I'm putting $10,000 in this then, right? Not a chance. But if I get to flip the coin every $100, well, yeah, I'd put $100,000 in it because the dispersion would be so small with that many coin flips all you'd see is the 105 every time. It'd just be like $5 every time you flip that coin. And your hourly wage on $5 per coin flip is pretty good. All right, so it's the same thing with these stocks. They have their own standard deviation, some of which hangs out, right, and some of which doesn't. So the coin flip had a really high standard deviation, right? It was 0 or 210. It's kind of as big as you can get. But that standard deviation completely disappeared once you had a lot of these. Now, for financial securities, it's not going to completely disappear in most cases, right? It will disappear some, but not all the way. And so what matters is how much is left, right? How much of the standard deviation is left after you put it in a diversified portfolio. Okay, and that means we can draw we have a different thing we can do for individual securities than we do for a diversified portfolio. So I'm copying this here. We're going to paste it again down here. Okay, but now we're going to change some of these things. So first of all, we have the same kind of thing going on here, but we have a different kind of risk measure now. So we're going to change. So this is standard deviation, but standard deviation is based on a diversified portfolio. So we need to know how much risk a security would have if it was in a diversified portfolio. And the way we measure that is a concept called beta. Beta is, the simplest way to describe beta is it is the slope of the line that you would get if you did a scatter plot of the individual security return with the market portfolio return. Right, so if I have, if I do another, like if I do it like this, right, and this is the market return, and this is stock A's return, and we got some dots here, right, we would have this line, and let's say that line had a slope of 0.8. Well, that would indicate that A has a beta of 0.8, right? When the market goes up $1, A goes up 50 cents. And right, there's other risk, right? So, and this would be, say, a stock with low individual security risk. But we could do a B. So let's put B on the same chart, and it looks like this, right? So now B has a much higher dispersion, right? A bigger dispersion. B has a higher standalone standard deviation, but it doesn't matter because when you put it in a diversified portfolio, it's going to collapse down to this 0.8 just like A does, right? All of this extra stuff is going to go away because it doesn't move with the market. And so we really only care about this market correlation because that's what's going to stick around once we put it in a diversified market portfolio. Okay, so the risk of individual assets is measured by their beta, which measures the correlation that remains after we put it in the market portfolio. So we have the same kind of thinking here. We have all of these securities, but now we have their beta instead of the return, except, right, all of this diversification stuff, right, doesn't actually apply to beta. Right? Remember, because beta measures the amount of risk that's left after we diversify, right? So if I have a stock, and it measures how much is left after we diversify, if I have, here's one and here's one, if I mix the betas, if I mix them together, the returns are going to mix, but the betas will as well, right? Because there's no diversification benefit because beta measures non-diversifiable risk. So if you combine things, in beta space, they just draw lines. There's no swoop. Okay? Which means when we look at returns and beta, what you should see is you should see roughly a line. Like this, right? So as beta goes up, returns go up. And this has actually been tested in practice. You can do this as like a statistical test. And in real life, what actually happens to this line is it looks something like this. So and it's not even that bad. It's just like on the very high end, it kind of does this. So that's a little weird. It's not what we'd expect, but it works really well for a lot of things. So honestly, so I will tell you my theory as to why this is. and we don't know, right? This is just me guessing, but I am suspicious that this is a consequence of institutional investing restrictions. So if I am a pension fund that's really trying to make a 12% return, and the market is only paying 8% and has only paid 8% for a long, long time, right? I need to invest in riskier things. And maybe I'm restricted in that I'm not allowed to use leverage and I'm not allowed to use derivatives. So basically I'm hunting for risk in a universe where there isn't enough risk to be had. And so that would mean I would be I'd have higher demand for really high beta assets. And since there'd be high demand, it would drive up the prices, which would drive down returns. Now, this could have been an anomaly in the data. Right, we wait 5 years and check again, and that's just pure speculation on my part why this is. But if you ignore this, right, if we take this out, like and it's really only the top decile. So if you're in the top 10% of beta stocks, things get a little goofy. But if you're somewhere in the bottom 90%, you do get a nice linear relationship between return and beta statistically. Okay, and when it was return standard deviation, we called it the capital market line, and that was useful for finding the value of diversified portfolios. This one is called I never remember to change colors here. This one is called the security market line. Okay, and it values individual securities. Right, so if I have an individual stock, right, if I'm going to put Google on this chart, right, Google is going to be somewhere down in here, right? It's going to have a high standard deviation and low return because it's not diversified. So on this chart, it's going to look bad. But down here, right, where we do beta, I would expect Google to be somewhere like here, right, where it has high beta, high return. It might not even be that high because Google is basically in a lot of respects a mature business at this point. And so the security market line is what we can use to find whether individual securities are mispriced. So if we find a stock that has an 8% return with very low risk, right, it would be up here, right? And we would say, wow, that is really out of line with what we'd expect given the security market line, right? That would mean this would be, to get a thumbs up here, right? That would be a good asset to invest in, right? And if we have one down here, then don't. Bad asset to invest in. So there's some trick to estimating beta. But actually, if you go to Google Finance, they report their beta estimates for individual stocks. You can actually you can use beta. And if you think about this, right? Let's do if I bust out the y equals mx plus b, right? So we're going all the way back to 8th grade algebra here or whatever. So I've got y equals mx plus b. And what's the slope? Slope is rise over run, right? So I get, and I'm going to use the point slope formula here. So I have y2 minus y1 over x2 minus x1. And what's y? So y is return, and what's x? X is beta, and what's the y-intercept, right? That's the risk-free rate here. Risk-free rate. Okay. And then we need y2 minus y1. So y2 is the beta of the market, right? Because this is the market portfolio here. And we could pick any point on this line, but let's pick the market portfolio. So the market portfolio is going to have the y value is going to be the return on the market minus the risk-free asset, right? Because that's y1. This is the risk-free asset down here. So we'll pick this point and this point. So return on the market minus risk-free asset over beta of the market. Well, what's beta of the market? Well, beta is, remember, it's how much standard deviation is left once you put it in the market. Well, it's going to have all of it left once you put the market. So, and it's going to move exactly as much as the market. So this is 1, right? The beta of the market is 1. It looks exactly like itself. And what's the beta of the risk-free asset? 0. right? So we get this nice clean formula. R is return on the market minus the risk-free rate times beta plus the risk-free rate. Ooh, that, yeah, and we got an extra little line there. Let's see if I can erase it. There. Okay, RF. RF. Oh, horrible. So this is the equation, right? It's just a simple definition of a line, but it's the equation that defines expected returns for individual securities, right? If you know a security's beta and the return on the market's pretty consistent, it's right around 8% in nominal terms, and the risk-free rate, it changes, but right now it's hovering pretty close to 0. So you can just plug in the numbers, right? You say, oh, Google has a beta of whatever it is, 1.4. I put 1.4 here. I put 8% there. I put 0 here, multiply it out, and I get a return. And it would be the return you'd expect if you invested in Google for 1 year. And so this is actually how we can calculate cost of equity capital in practice. If I am a company and I'm selling stock, it'd be nice to know, well, how much are my investors going to expect from me? Right? If I sell stock and give them 5% a year, will they be mad at me or not? Or will it make my stock price go down if I do that? Or will it make it go up if I do that? Well, it depends on the beta of the company. And so you can, like for example, in for Technicorp in Minneapolis, one of you did that for your, anyway, so yeah, so for Technicorp out of Minneapolis, they report in their financial statements that they have a cost of capital of 11%. And so that comes based on their beta and the current market return and risk-free rate. And so if they accept investor money, if they accept investor equity money in their company and find a 9% project, it's not going to be good enough. The investors will be mad and the stock price will go down. But if they accept 11% money and give them 14%, their stock price will go up. So this is very important for capital budgeting. So when we're not doing that in this course, that kind of thing happens more in the next course in the sequence. But if I'm trying to find the value of a project and I can find the return, right? I could find the internal rate of return of the project, and that internal rate of return better be more than the cost to raise the money for the project. And if I use all equity financing, that cost is going to be this cost right here, right? It's got to be bigger than that. If it's not, don't do it. If it is, do it. And so, this is actually a really important concept in corporate finance, the notion that we can reduce the risk of a financial security to one number, right? So this is our one risk number, beta, that summarizes not only the risk of a security, but the risk of a security once it's in a diversified portfolio, and therefore the risk that you get compensated for. And that's what we care about, right? What is my return going to be if I put up with this amount of risk? And also encapsulates the idea that you don't get paid for risk you didn't have to bear. Right? If I buy one stock and put all my money in one stock, right, this is a dumb choice. And it means I have a very risky portfolio, but that doesn't mean the market's going to give me a lot of money for it, because that's my fault for being silly. Right? I could have put it in a diversified portfolio and made it a lot safer. So the market doesn't pay you for being silly, but it does pay you for putting up with risk that can't be eliminated. Right? And that's what this is talking about. So that is sort of the broad introduction to this whole thing, which we call the capital asset pricing model. Capital asset pricing model. And I'm just going to leave this green. Capital asset pricing model, or CAPM. And it's very, very important in academic finance and in practical finance in everyday life. And so when you see beta on the Google Finance page for a stock, it's implicitly using the capital asset pricing model to come up with an expectation for returns on the stock given the statistical properties of its returns as measured by beta.